Good afternoon. My name is Pat O'Meara. I'm the chairman and CEO of Inveniam.io. It's a pleasure to be with each and every one of you virtually. And I'm assured that there's a great number of you out there in the ether listening to this. And we hope there's even more after the fact watching recordings. It's just a great pleasure to be with FinTech Connect and with you talking about really the convergence of two different realities coming together, right? We're talking about this distributed data economy as people want to control and maintain their own data and are suspicious of large databases of third-party oracles maintaining their data, as that's been abused, misused, malfeasance has occurred in the use of people's data by large entities. And so asset owners, business owners are maintaining their own data. And as they do so, they have a need to control that data, shepherd it, but then also use it, not only for their own use, but to credential it so that others will trust that data over time. And that's really where Inveniam comes in. Inveniam is in the business of credentialing data and providing a mechanism for that data to be trusted over time on the performance of an asset. And this can help in a number of ways, but we provide observability into an asset's data that can be used to drive real-time pricing or price discovery for commercial real estate, for private equity, for private credit. But for any real asset that you need to credential the performance of that asset, provide observability over time, and then make that data high functioning where it is tool ready to be used in multiple tools, but it doesn't reside outside your own systems, so that when it is used, it's sent to the tool, and then you have the ability to ensure that that data is coming back to you and it's not out there, so that we're preventing data loss, loss of control on data. And this really is what Inveniam's about. And my name is Pat O'Meara. As I said, I'm the chairman CEO, and I've been driving Inveniam for about 4.5 years. My background is I worked at Raymond James. I worked at Bear Stearns for a while. I left in 2000 and started my own investment bank. And we were focused really on a part of the credit markets that we felt were mispriced based on bad data. And so we went into that part of the credit markets, became kind of the globally dominant player in that space, sold that business 14 years later, became chief investment officer for a small university. And then I left there and started Inveniam 4.5 years ago, really on the core same thesis, but with a different set of tools to go about what I did in the first case, right? And when I started my first business, we were arbing a lack of data and understanding for the credit in a particular niche where we had knowledge and we had insight. And so we were able to work and in that market, make the market more efficient, change the borrowing cost for those borrowers by 300 to 500 basis points. And we were paid a fee as we did that. And it was a nice business. What we're doing is the same exact thing. We're facilitating better data on the performance of assets, but we're doing this utilizing data so that this data, when there's a data arb where there's asymmetrical data in a trade, usually somebody makes out like a bandit in that situation. And what we're doing is we're facilitating a better control of data over private assets, better understanding of data, so that these private assets can be priced more efficiently, they can be traded more efficiently, they can settle more efficiently. And when you have enough of like assets being priced consistently with the similar, on a consistent regular basis with good visibility into the underlying data, then you can start doing things like creating indexes, and then you can start creating derivatives off them in order to hedge. And there's a whole bunch of financial tools that can be created utilizing this better data on private assets. And so let's talk about that. What do we mean by this, right? So as we think about these private assets that are going to exist globally, think a commercial office building in downtown New York, right? So right now, what happens is there's a number of data services that scrape data from the outside to talk about that asset, what its value is, who the tenants are, what it's worth, but also they go in and they actually try and get primary source data with literally sending investigators in. And that is against the wishes of the real estate owner, right? That they do that, where questions like how much free rent is being given, what are the tenant improvements that are being given in order to induce a tenant to sign a long-term lease. And what we're doing is we're saying that type of a model is going to die as we enter into a distributed data economy where there's millions of data creators. There's an enormous volume of data that's being created. And we think there'll be lots of validators, but people want to validate their own data in their own place of rest. And that's really what Inveniam does, which is we credential data. We're an operating system for data that is independent of its location of storage or its use, right? So what we're doing is we're credentialing that data wherever it sits at its place of rest. It can be in multiple different systems, and we digitally certifying it using a SHA-256 to create a hash. And then we anchor that into a cryptographically secure ledger that can be utilized every time we want to go back and check that data. We make sure those hashes match. And if they don't, we know that the data has been altered in some way, shape, or form. What that does is it prevents you from having to take data about your asset and turn it into a picture or a PDF for the sake of surety, and you can leave that data as high functioning. So you cryptographically secure it, you index it, you field that data so it's ready for whatever tool you need to, and then you validate it. And what this does is it verifies the information, it makes it observable so that we can start pushing it in tools. So let's take that office building in New York City, right? Where the owner of that office building is going to start credentialing their data, and they're going to make it observable on a permissioned basis to those that they allow. And they make that data observable, like permissioned access, not just where they can see the data, but where the provenance of that data itself is there, and it can be verified by a third-party auditing firm like a Deloitte, right? And as we do that, we can go in, we make those inputs observable. And this is everything from the maintenance of the mechanical systems. This is everything from key fob data, foot traffic, motion sensing, light fixtures, where what we can do is we take geofencing of that asset, we take the Yardi data, we take the computerized maintenance and management systems data, we credential in its place of rest, and we relate it to each other. And what happens is you have a very complete mosaic, which is like a memory for that asset that's anchored in time, right? And let's relate that exactly to how our own memory works, right? We're going and we're denying something happened, that I spilled the punch bowl at the Christmas party 5 years ago, right? And my wife goes, no, remember you were wearing the blue shirt, you spilled your coffee, you had a little coffee stain, you looked down on it and you turned, you were upset about the coffee stain. And what happens is we anchor the memory, those memories, and the whole episode comes back. And I'm going, oh, that's right, I did knock that over, right? What we're doing is we're creating a data memory that is not device or network specific, but actually has commutability, because the individual piece of data is not only anchored into a cryptographically secure ledger that we can say that from an immutability standpoint, it hasn't been altered, but also it's related to a whole bunch of other data points that we can create what's called probabilistic determination as to the truth of those other data points, as long as those data points are in relationship to one another over time. So what do I mean by that? So think of a commercial office building, and you're talking about things like toilet flushes and elevator usage and foot traffic and key fob data and rent payments. And we have a very complete picture of that asset from a use. But then when we start to put operational data underneath it, as far as how it's being maintained, et cetera, we're going to have an enormous number of KPIs where we understand that asset. Well, what does that mean? That means we have this data that we can start pushing into a tool. So one of our partners is Cushman & Wakefield, where we can push that data to them. They can give us a monthly price on that commercial office building. And that monthly price, because there's observability of the inputs, the owner of that asset on how they hold it can change from what's called a level 3, according to IFRS 13, FASB 157, or ASC 820, from a level 3 asset to a level 2. Level 3 being an illiquid asset, level 2 being a marketable alternative. So by this better data being fed into a tool that's a sophisticated model using period comps from other like assets, we can start to see illiquid assets or private assets like real estate suddenly being treated as marketable alternatives. This is going to have enormous value to people who have regulated capital as it relates to their balance sheet. So think banks. This affects banks in their tier 2 capital. This affects their capital at risk, their value at risk calculation. This impacts insurance companies. So think insurance companies who, if they hold a real estate asset on what's called Schedule BA, they can move using our software that asset to Schedule A. That moves it from a 20% capital reserve to a 10% capital reserve. We literally can reduce their capital reserves by 50%. If they're a CML or commercial mortgage loan lender, whole lender, as many insurance companies are, they can go ahead and as they tranche those loans from CM1, CM2, CM3, they can tranche those, create an AB piece and do credit optimization to push the A piece into CM1 and the B piece into CM3 and do credit optimization using our software without the need to do a public securitization. So this is all around better data that allows you to push data into tools that are going to, because of the better data, unlock better accounting treatment because you're going to deliver better comps. So think back to exactly what happened with high yield bonds, right? In the 2000 timeframe, high yield bonds were considered level 3 assets. The pensions funds got very pushy on this with FASB and said, hey, listen, even though my specific bond has not changed, there have been enough assets that have traded hands with similar, credit signatures and structures in where I am in the credit stack that I can price this asset. There's a strong enough R2 or correlation between what is trading and that own asset that I have. Well, those all became level 2 assets. And what happened was the high yield bond market exploded because the number of people who could invest in it went through the roof. In addition to this, we started to see things, how they traded became much more efficient and it just became a much better market. We're now seeing that in real estate as we're opening the door because we have better data that is private data. Doesn't need to be in an Edgar database. We can credential the data at its place of rest. So think of it as a form of creating a distributed Edgar database for these private assets with on-demand permissioned access to the provenance of that data. So the owner says, okay, if you have a right to see it and you want to see it, that's great. Well, what will this mean? We'll talk about private equity and private credit in just a minute. But in real estate, think about that. Right now, if I want to buy an office building in downtown London, what am I doing? I'm literally going to put a bid in. 120 days later, we're going to close after I've done, my structural engineers have gone in. There's been a hazardous materials report. We've done a systems report with looking at all the different systems. Then we can, when all those questions are answered, focus on bid versus ask. When all of those asset performance questions have been stipulated, what can you do? You can focus on bid ask. We think that eventually though these assets will trade same day, but we think in the near future, right, 3 to 5 years, you're going to see real estate closings for commercial office buildings closing in 2 to 5 days, because I'm going to be able to look at that asset's KPIs across literally dozens of different key performance indicators that I can look at how is that building performing not only against the other assets around it, but the assets that I already own in my portfolio, and I can understand how it would fit within my portfolio and how it's performing. When I can do that and I understand the performance of the building, not at that moment in time that I had to rely on a third-party oracle to come in and write a report, but I can see that over time, right? And this is just like getting an audit for your financials, but it's an audit for your data on the performance of the asset. We're creating literally a memory, right, for that asset. So think of a digital twin of a commercial office building, but as the digital twin is being created and updated with new data at every moment, we have the ability to credential that data. And so that's literally what Inveniam is doing. This is going to open the door dramatically to all sorts of innovation, because when you can trust the data, suddenly people are going to be able to use the data with new tools. You're going to have tool-ready data that can be trusted. And what we're going to see here is data that is in my systems, that when I share it with you, you're going to have a mechanism to evaluate that data, not just on me, but because of the relationship of that data with other data sets that you trust, know, or interact with yourself. So you can judge the veracity of that as a frame of reference. That's going to change the way people, as they interact and trade private assets, work with one another. And what this is literally about credentialing private assets. And so Inveniam is right here at this cusp of two different things, right? A global macro event where we're seeing more people move into the private markets, right? As far as number of issues that are on the public markets, we're, over a 60-year time span, we're at the lowest level as far as number of companies that are public, even though the size of them are huge. Yet what we're seeing is this enormous private market that pension funds, regulated entities are needing alpha, right? The bond markets aren't yielding it. So they're having to go find that alpha to find the return, to fund those obligations that they have, whether they're pension obligations, whatever they might be, market obligations, that literally they're going into the private markets, they're seeking more, but to do so, particularly as fiduciaries, they need better data. And that better data they need not just from a GP who's managing it and providing marks on assets that are inside their fund, but they're going to need third-party marks from a branded third party who you can trust the methodology of that third party, whether it's a Deloitte, whether it's a Cushman & Wakefield, somebody else like that, who's literally going to put their name on the line. They're going to put a price on it. It's going to be a third party mark, so that that LP, whether we're talking about CalPERS or CalSTRS or CPP or any of these large pension funds, that as a fiduciary and that they're making an allocation, they need to have good transparency. And with that third party mark, it helps them evaluate the GP, right? But not only that, the GP wants that third party mark for all of the individual assets in there. Why? Because that's the foundation for a secondary mark for limited partnership interests, right? If all of a sudden, if we have, as a major pension fund or an endowment, a meaningful position in a fund, and I want to seek a secondary trade. Right now, there are specific funds that they facilitate those secondary trades. Those are sold at major discounts, and they're sold at major discounts because it's a lack of marketable data. That's 20 to 30%. And so what we're doing is we're using this as a mechanism to facilitate an underlying mark. And we do this, as we said, by digitally certifying the asset, anchoring it into a cryptographically secure ledger. We can do that on a public blockchain like Ethereum or Tezos. We're live on both of those right now. We can do it on IBM's Hyperledger Fabric. We're live on that right now. We can create a meta chain, which is where we use Amazon's Quantum Ledger as a single node ledger, or we can put a Merkle tree on your own data systems where you are the node. And that's, we call that blockchain for, with training wheels, right? For blockchain for beginners, with a Merkle tree on your own data system where you're writing into that, but you are the node, right? Now, we're 2 quarters away from being an enterprise-wide Oracle on R3. We'll be live on Quorum relatively soon. So we're not only chain agnostic, we've been called chain promiscuous, right? Because the reality is we were on Ethereum as the first one. The cost of transacting the other day we were going to transact something on Ethereum with a number of people. With one of our clients, we were showing them, how we were anchoring that data, and the cost of that transaction was $129 to anchor data into the payload of a block, and that's just non-economical, right? And we understand 2.0 is on the way, but we're excited to see that when it comes. But right now, that we are actually whispering to other chains, where when we have our own that asset and we're anchoring that into the payload of a chain, we can whisper to the most economical chain, or we can write to the most economical chain and whisper to the other chains to fill in over time, because there is a reality of chain entropy, which does happen. So that was a question from one of the members of the audience, and I encourage any other questions that you might have. And so the question is, DLT adoption been accelerated by COVID or hindered? Inveniam, where people are doing third-party diligence and they need a way to validate data, and the fact that we're using the DLT, we don't bring up, and most people don't ask, they just want the outcome. COVID has been an enormous catalyst for us, right? I mean, where people are moving forward. But digital transactions, executing digitally, crypto has just, blown up. As it relates to DLT and tokenization and things like that, we think tokenization, every asset in the world is going to trade as a token in 5 to 7 years. That's just a fact. But the adoption of that is limited. Our use case really is better balance sheet treatment, moving assets from 3 to 2, anchoring that event series to a token, that when there is a market for those tokens, all of the data associated with that underlying asset is forever connected to that token. So that's there. So we do believe that that's happening. And there has been some acceleration as people want to execute digitally. And there are difficulties using legacy systems, right? Right now, we're doing a project with, one of a global 100 company, where they're trying to reduce end user computation. And as they reduce end user computation, where they're automating, they need to not only see the provenance of the data, but the provenance of the definition if it's contractual, meaning it's not industry standard, right? And what we're doing is we're anchoring those, we're showing that where it's in the payload of the block, we're pushing that data through. And then once that's ready, all the way through a waterfall, and we're ready to distribute those funds, we can push it into a legacy system like InvestTran, or we can create a smart contract and distribute it on chain. Now, they're not interested in distributing on chain now, but they love that that functionality is there, and that they're future-proofing themselves, because they all realize that's going to be how it's done in the future. So somebody is asking me about CBDCS, from my standpoint, we are focused not on and I'm sorry, I was responding to that chat. We're not, as it relates to crypto and central currencies and how those are maintained. That's not really Inveniam's. Ballywick. There's a lot of people who are very well informed who think about those things. What we're doing is, as private assets get traded, you need a mechanism to trust data around the performance of that asset if it's going to get traded, right? Something's not liquid because you can clear and settle it. Something is liquid because you have data that you can trust, that you understand. And then using that data in tools that are going to provide outputs that you can rely on. And as a fiduciary, you can rely on, and other third parties can credential, third-party oracles, right? That is what is going to move private assets trading, particularly on DLT. Now, how it relates to central banks and digital currencies, that's a part of the ecosystem that we're interested observers in the realities that are occurring, but we're not participants. blockchain at the moment seems a series of islands. Will the next decade see effective interoperability implementation? Absolutely. So think about the early days of the internet, right? When you had to go in and you had to use Archie or a bunker to index what was in a directory, right? You were using a Archie or bunker directory, and you were indexing it, going in. And what happened? Mosaic came over, sat on top of it, and it became a mechanism for the non-technical to use it. And then the internet exploded. So one of the things that Inveniam did is we went to everybody, Coinbase, Anchorage, Gemini, Fidelity, you name it, every custodian that's out there. And we said, listen, you need to create a wallet for a custodian to use that fronts multiple chains. And they all said, oh, that's really cool. That's neat. We won't build that for you. So we've ended up building a hub which is 100% interoperable. And right now, we're not sure what we're going to do, whether we're going to sell it or we're going to just open source it and give it away. But it is 100% imperative that when people are using a chain, they need to understand chain entropy will occur, which means just like trade entropy happens, or a steam engine eventually will lose pressure, right? A trade, the dollar yen trade, eventually wore out, right? Chain entropy is going to happen, whether it's the community dying and not being maintained, whether it's the lack of nodes, whether it's being hacked, it's not being updated, something comes out that's better technology. The reality is you have to be able to operate not only within a chain that you yourself control as a single node of meta chain, an enterprise chain as you're relating to third parties that you're in business with in a trusted environment, and then those assets that are going to be interfacing with the public directly. We think the ability to move from a meta to a private to an or enterprise to a public chain and be on all three, and the data to correlate between them is inevitability. It is, and we're building our software 100% where we can operate on multiple chains at once. So absolutely. By the way, the level of complexity went up by a factor of 10 when that happened, right? When we said, okay, we're going to move beyond one chain, we need to operate on multiple chains because we have some banks who want to use one because they've made a major investment in that chain or that operating system or that consortium, yet they also want to deal with third parties, and they also understand that the public is interacting on public chains, and the viral benefit, the networked effect of the public chain they want. That's the whole point of the distributed ledger. And so using the distributed ledger as a new form of a database is a failed, broken idea. Using it as a mechanism, right, as a triple ledger, as a mechanism to impart trust on something that is typically in a two-ledger system is in fact what it was meant for. Now, if you want to impute that trust on an enterprise system with just a small number of players, that's great. But if it's going to deal with the public, you really do need a public chain. And so people are going to have to move from a meta chain to an enterprise chain to a public chain with not only the data that they're anchoring to multiple chains at once, and then they're whispering to the chain to make up for those holes in the event series for data that was lacking there. And then we do think that there's going to be master regulated contracts that really go between one and another. And I'll give an example. Securrency is doing a great job with some of the ETF work that they're doing for public assets, where they can go, where something can sit. You can trade a wisdom tree ETF on Stellar, and then you're going to be able to convert that directly over if you have a wallet where you want your wisdom tree ETF shares in a wallet that's on Ethereum, right? And so that movement that they've done back and forth is fantastic. It's groundbreaking work. We're doing the same thing, except in the private markets with multiple chains as well. That was a great question. Any other questions from anybody? I want to thank everybody for taking the time to be with us. We're super excited about all of the progress that we're seeing as the DLT is used, not as a panacea where it's going to become a database and it's going to replicate tools that it was never designed to replicate, but instead it's an additive layer that is a mechanism to commute trust in a trustless environment and to affect transactions. And when we can anchor enormous event series to a single token, where that token provides access not only to all of that data, so the data travels with it, but in addition, where you have trust in the data over time, we're going to see entire markets open up when you can not only trust the data associated with an asset, but then you can relate your own performance of your assets to it and other data to it, so you can see the performance over time with depth. It's going to allow all sorts of unfolding of how things are going to trade in the future. I want to thank everybody for the time. I really appreciate it. And all the guys from FinTech Connect, it's been great to be with you.